Okay, so let's start. Um, Today I'm going to talk to you about one funny game that I saw. So it was one article that was that Gary found, and he put it on the forum. And there is one professor, or Ole Peters, explains about some errors or some problems in economics. And so now we are going to go over one game that he described in his talk. So what is the game? So this is the video. Let's. Uh, I will let him explain what the game was.
Life really should be playful, I thought I'd start tonight's lecture with my favorite game. And the game has the following rules. You're given $100 and you invest them in this game where you're tossing a coin once a minute. And if the coin shows heads, you win 50% of your wager. If it shows tails, you lose 40%. Just to explain to you how this works, over time, we will be repeating this game. Here's one sequence where I'm playing for 5 minutes. It's very simple. I'm tossing a coin now.
Sorry,
On the first
Tzanko,
two
I can't
tosses
hear
here,
anything.
I lost 50% each
Okay.
of the time. So
Apparently there's a problem with the
40%,
sound.
I lost 40%.
Let me
So on the
see
first
if I
toss, I
can
lost
fix it
40%,
somehow.
I went down to 60, then I lost 40.
So there is some problem with Google Meet, but on YouTube you can actually hear the sound. Um, what I will do now is I will play it because I cannot really figure out in short time how to fix this issue. So I will just play the video, and people on YouTube will be able to hear it, and people watching Google Meet, I hope you have some patience. I will explain after the video finishes.
Percent of the 60, I went down further and so on. Then I gained, I lost, I gained. So you get these trajectories of wealth developing over time in this
Okay.
game. So I thought I'd play, I want to understand what happens in this game.
Okay. So let me explain again. So what are the rules of this game? You start with $100, and then you play once every minute. You toss a coin, and you have 50% chance of getting heads or tails. If you get heads, for example, you gain 50%, and if you get tails, you lose 40% of your money. That's the game. So now let's see what happens if we kind of try to average this game. Uh, First, what happens if we have a large number of people that play the game for some small amount of time, for example, for 60 minutes? let's see. I will let again the video play, and maybe we can. You just those that don't hear the sound, you'll just see the pictures, and I hope it's clear.
I'm really just interested in the fundamentals here. So I'm now averaging at every minute, at every moment in time, I'm averaging over the 20 trajectories that I've generated. And I'll get a line that looks like this. You can see that it's less noisy, but it's still quite noisy. So maybe 20 sequences is not enough. I should go to 1,000 sequences. That's still somewhat wobbly up there. So how about 1,000,000 sequences? Well, that looks pretty good. If I average over 1,000,000 sequences, I can clearly see that this is a favorable.
So what happens here? Ole Peters, so he shows the demonstration. We had 1 million people. Each person plays for 60 minutes, and uh, it turns out that on average, those people will win. Yeah. Now, let's try to do an average in a different way. So what happens if you don't have 1 million people that play for 60 minutes, but you have one person that plays for a very, very long time?
Long time. So let's do that. This is the original sequence that I showed you right in the beginning, where I'm playing this game, tossing a coin once a minute for 60 minutes. And now I'm saying I want to get rid of the randomness by considering longer and longer time sequences. So I'll play it instead of for an hour, for a day. Here's what happens over a day. You can see that the fluctuations become smaller. If you look at this, it really just bounces up and down. You don't know what is happening. Here, the fluctuations are a little smaller. This inset up here is just the original trajectory, and these lines here indicate that I'm blowing up the initial 60 minutes to that inset. So this is really just continuing the same game that I played in the beginning. Still, to me, this is still pretty noisy, so maybe I want to play for a week instead of just a day. So now I'm playing for a week. Noise diminishes. I'll play for a year. Okay, now I've played for a year, for 12 months, and the perhaps surprising thing is that I've lost. The noise has completely disappeared. So there's really no reason to believe that there's any uncertainty in this result, but I'm losing. So what on earth is going on?
So what's going on here? It turns out if you have one person that plays for a very long time, so in this example, one person plays for 1 year, and you lose. So if you take average in one way, it seems that the game is beneficial for you. If you take average in a different way, it seems that you lose. So yeah. So now the goal of this talk right now is to explain what's happening in this game in more detail. So to see why this is so weird. So what's going on? So you start with $100 and you play once. If you win, you will get $150. If you lose, you will end up with 60. So at the first moment in time, you had your amount, which I denote by x0, which is 100. And then in the next moment, after you play once, you get either 150 or 60. This is the amount after one round of the game. You can continue playing like this many times, and you can, and more generally, at time t, we can denote the amount that you get by xt. So the how those amount changes over time is shown by the returns of this game. The returns tell you how much your amount changes after each round. And how are the returns defined? Well, actually, there are several ways to define the returns, and I will look here at two different ways. So the normal returns, I call it, this is the amount that you get at time t divided by the amount that you get at the previous moment, t minus 1, and you subtract 1. So in our case, the return at moment time 1 is either 0.5, which is 50%, or it's minus 0.4, which is minus 40%, just like the game described. So this was one way to look at the returns. And if we know the returns after each round, well, we can compute how our amount changes. So at time t, the amount is equal to the amount at time t minus 1 multiplied by the returns plus 1. And if we apply this formula iteratively, if we start at time 0 with amount x0, at time t we'll have x0 times r1 plus 1 times r2 plus 1, and so on. Okay. So this was one way to look at the returns, but there's another way. If you take this formula that I showed at the end, here we multiply many things. So in general, in math, adding is easier than multiplying, and we can take logarithms, and so we'll arrive at a formula where we sum things, right? So the logarithm of the amount at time t is equal to the logarithm of the amount at time 0 plus a sum over the logarithms of the returns at each time. And so those logarithms of the returns, so log of r t plus 1, those things we will call the logarithmic returns. So this is another quantity which kind of tells us how the amounts change after each round. And the reason why this game that we described is so weird, it turns out to come from our kind of wrong intuition about the returns. So we think about, in one way, we think in the one way that we average, we consider normal returns, while in the other way in which we average, we to do it correctly, we have to consider the logarithmic returns. And I will show now how this happens. So let's first look at the first example that we had in the video. So we have a certain amount of people, and let's assume that all of those people play only once. So in the video, we had 1 million people, and those people played 60 times. But actually, to understand what's going on, it's sufficient to look at the case where all those people play only one time. So each one of those people started with $100, and then each one played, and each one got a different return after they played one round. So we can try to compute the average of the amount that they had after one round. So what is that? Well, so one person will have gained or lost like 100 times 1 plus the return of that person. And we have to sum over all of those amounts, and we divide by the number of people. So this is 100 plus 100 times a certain sum. And if you look at this sum at the end, this is actually equal to the average of the returns. Well, it looks like the way that we compute average of the returns. So if k is very large, so this sum should converge towards the average that we have in our case. So here we assume that all of those returns, they don't depend on each other. So this is what is meant by this independent and identically distributed random variables. So they all behave in the same way. And yeah, so the sum at the end, if k becomes very, very large, it should converge towards the expectation of the return, so the average return. In our case, we know what it is. So we have 1/2 chance to get 0.5 and 1/2 chance to get minus 0.4, which is 0.05. So what we see is kind of the average return is 5%, just like what we intuitively would think happens. And on average, one person of those K people would gain $5. So you see how just like he showed in the example in the video, in this way here, it turns out that this game is good, so we win. But the key part here is that we take an average over many people. So we play once, but we have many, many people that play the game independently. The same logic will hold if we don't play only one time, but we play for a fixed amount of turns, like n turns, and then we have a large number of people, k. So here you can think of n is fixed and k can go to infinity. So if n is fixed and k goes to infinity, it turns out that on average one person will a person will gain money. Actually, and you can look at the video after this talk, what it turns out that it happens is that a very small amount of people will gain a lot of money, but most people will lose in this situation. So this is not a very good game to play. Even though on average it turns out to be good. And very often we don't really care about what's happening, what is happening under this scenario, because we don't often have a situation where we have many people and each of them independently makes a bet like this. Instead, what's is much more important for us is what would happen if what will happen with me. So I'm one person and I play the game many times. I don't have this opportunity to turn back time and play again, right? So this scenario that I explained, okay, it's interesting and it turns out that you win, but it's, I mean, that's not a realistic scenario. Let's now try to take averages in a different way. So we have one person and this person will play many times. What happens in that case? So this was the formula about computing the amounts after n rounds. And so I took the logarithmic form. The logarithm of my amounts after n rounds is the logarithm of the initial amount, the logarithm of 100, plus a sum over all logarithmic returns for each round. And this sum, I can express it as n times 1 over n times this sum of logarithmic returns. Well, this part, 1 over n times the sum of the logarithmic returns, it's actually very similar to the average of the logarithmic returns. And if we get n to go to plus infinity, so this term should converge to the average of the logarithmic returns. Yeah, so this is what I say here. So yeah, this term converges to the average of the logarithmic returns. and we can compute this. So we have 50% chance that we will get logarithm of 0.5 plus 1, and 50% chance that we'll get logarithm of minus 0.4 plus 1. And it turns out that the expectation of the logarithmic return is minus 0.05. So what's important here is that this amount is negative. And the fact that this is negative means that we are going to be losing money. And if we replace this in the previous formula, it turns out that after n rounds, especially when n becomes very big, the amount that you will have will be 100 times e to the minus 0.53 times n, which converges to 0 very quickly. So, yeah, it turns out that we lose. So you see where the problem was with our intuition. So when we looked at the game, and intuitively we were actually thinking about normal returns, but actually to understand what's going on, it's more correct to look at the logarithmic returns. So actually those two numbers very often are not that different from each other. So if the return r is small, then logarithm of 1 plus r is similar to r. And here you can see one graph. I have plotted the two functions. And around 0, they are very, very similar. Here's a graph of the difference. So this is the error. How far is r from logarithm of r plus 1? At 0, there is no error. The two things are equal. If r goes to is positive, well, there is some difference, but it's not that big. But if r is negative, the difference becomes very big. And as r goes to minus 1, the difference goes to infinity. And intuitively, this is something that you probably already know. So if you have a portfolio and you gain 90%, this is not as so gaining 90% and losing 90%, there's a very big difference between those two things. So losing 90% means you basically lose almost everything. Gaining 90% means that, well, your amount doubled, which the fact that there is such a big difference between gaining 90% and losing 90% comes from the fact that actually what we care about is logarithmic returns and not normal returns. But if r is very close to 0, then the two amounts are close to each other. And economists actually use this fact in some analysis. The reason for this is that the normal returns, they're much easier to work with. So they are kind of a linear function, and the logarithm is a more complicated function. So we can simplify a lot of analysis if we replace logarithmic returns with normal returns. So for example, in modern portfolio theory, at least what I've seen when I looked on the internet, how everything is described. So people there, they use normal returns. They don't use logarithmic returns. And the reason why they do this is because if you use normal returns, you can find the optimal portfolios using linear programming, so linear optimization. If you instead try to do modern portfolio theory with logarithmic returns, well, you cannot use that. The methods that you have to apply are more computationally intensive. So what I've seen is in the literature is that they just apply this approximation. And another thing, another place where we use normal returns is Sharpe ratios. So this is the formula for the Sharpe ratio. If you have a portfolio, the Sharpe ratio is the expectation or the mean of the return of this portfolio, of the returns for like each period, divided by the standard deviation. And what's important here is that we again use normal returns and not logarithmic returns. That at least that is what I have seen on the internet. So I'm not an economist. I just looked around on Wikipedia and other places, and everywhere I just saw that the Sharpe ratio is defined in this way. Now, in our game, if you compute the Sharpe ratio in this way, you'll get a positive number. So according to the Sharpe ratio, it would seem that our game is profitable. But actually, we saw that it's not profitable if you play many times. So the Sharpe ratio is misleading. And how do we compute this Sharpe ratio? So we look at the historical performance of a given portfolio. For each day, we get a certain return, and we can compute averages based on those returns that we get for each day. But if you look at our consideration that we just showed, well, it turns out that the way we compute this average is as if we have many identical portfolios that we hold each one of those portfolios for one day. Instead of the actual situation where we have only one portfolio that we care about that we hold for many days. In practice, this is not a problem. As I said, normally the returns are not very big. In the literature that I've seen, they say, okay, if the return is about 1% or less than 1%, then we can very easily make this approximation, so we can replace logarithmic returns with normal returns and everything will be fine. But in some cases, we might get problems. So, for example, in the crypto world, things are much more volatile, and I would expect that, especially at times where we have pumps and dumps, the changes of the prices can become very big. And in such moments, the normal way that we do analysis would break down. So it's good to keep those issues in mind, I guess. Okay. So this was the explanation and what's going on and why this game is so weird. But actually, this game that I showed, it's even more weird than that. It turns out that you can actually win money with this game. So I'm going to turn on the video now, and later I will explain.
And now we'll come to the actual talk. This is the basic concept, and I'll start applying that to a few classic problems in economics. The first will be the leverage problem. So the question is, how much should I invest in a favorable investment, in a favorable game? So let's look at these two perspectives again, the time perspective and the ensemble perspective. They both have problems. The ensemble perspective looks very nice, but the problem is that it's inaccessible. We would have to be able to access all these parallel universes. So that's not really available to us. The time perspective, it doesn't look so nice. It's too risky. But maybe, maybe we can find a compromise. Maybe we can trade them off and somehow get the best of both worlds. And the idea there is to keep
By the
some of
way,
your money.
I
What
think we
happened
can't
here was
hear
that I
the
was
audio from the
investing the
video.
$100 that someone gave me in the beginning, and then I kept investing whatever I had at every moment in time. But I don't have to do that. I could say, well, I'm not going to invest $100. I'll invest less. So I'm investing less in a favorable game. And maybe that's a good
Sorry?
idea. Because not investing something and sitting
The
on it,
video
in
is,
this case,
I
is
can't
like
hear the
freezing
audio.
your money in time. So you do have access. It's almost like you could go
Yeah.
back in time because you can access that stuff that you haven't spent in the beginning.
There is some problem. I'm having some problem. So if you watch this stream on YouTube, you can hear the video. But if you watch it on Google Meet, you cannot hear the video. So I cannot fix
Okay.
it now. So I'll just play the video and then I'll explain with words.
Okay.
So this is the central idea. So keep some money safe in this game, meaning reduce your leverage. What we had here in the beginning was a leverage of 100%, meaning we bet everything we had. So I'll now sequentially reduce this leverage and show you what happens in the time perspective and in the ensemble perspective. In the ensemble perspective, you can already guess what happens. It's a favorable game, and now I'm investing less in it, so my money will grow more slowly. What's interesting, watch what happens to the time perspective there. As I'm investing less in every round in this favorable game, I'm also losing less. And I'm not just losing less, I can actually go to a level where I'm gaining.
Okay, so
I can actually lose
let me go again over the video. So what he shows here is that let's change the game a little bit. So every time we're not going to invest our complete amount, but we're going to deleverage. So we're just going to put a little bit of the money. And if we look at the ensemble perspective, so this is the first example where we have a lot of people, but for a small amount of time. What happens is what you expect. So actually, if we invest less, then we will gain less. But in the time perspective, what happens is very strange. So it turns out that we can actually gain money. So right now, I have paused the video on the graph where he is only putting 10% of their assets into the game at each round, and it turns out as time goes by, he will be gaining money. So this is very counterintuitive. You see, like here, we have a game where if you invest 100%, you lose for sure. But if you invest 10% each round, you will win for sure. That's something that I personally find it very strange. So let's see the formulas and see how can it happen like this. Yeah, so we can gain money if we invest less than 100% in each round. So let's assume that we choose one quotient, which I call lambda of our assets, and we at each round we only invest this quotient, and we always leave the rest aside. So how will our amount change over time? So if we had at moment t minus 1 the amount x of t minus 1, and our normal returns were rt as before, then at the next moment, what we will have? So we have lambda, we take one quotient equals lambda of our amount, and we invest it. And so we gain, we apply the returns to this quotient, and then we leave the rest aside. So total amount that we will gain is x t minus 1 times lambda times rt plus 1 plus, well, the rest that we left aside, x t minus 1 plus 1 minus lambda. Sorry, times 1 minus lambda. We can compute, it's not difficult to see what are the normal returns in this case and what are the logarithmic returns. Well, the normal returns turn out to be lambda times rt, and the logarithmic returns are logarithm of lambda times rt plus 1. So let's see what will happen if we choose lambda in different ways. Here I have plotted the expected logarithmic return for different values of lambda. So you see, if lambda is equal to 1, then this is the game that I already had. And we lose our expected return is minus 0.05, as we saw already. If lambda is equal to 0, then that basically means that we don't invest anything. So we just keep our money and don't do anything with it. So then the return is 0, as expected. But it turns out that at small values of lambda, the return is positive. So the expected return is a positive number. I think the optimal value of lambda in this case is 0.25. Yeah. So more generally, we can show that if we have a situation where the expected return is positive, but the expected logarithmic return is negative, we can find such a value of lambda, so where we will we can get money. So this is for more general situations. And to analyze this, so the expected logarithmic return, we can think of it as a function depending on lambda, and to see when a function is growing or increasing or decreasing, there's standard method. So we normally take its derivative and look at what are the values of the derivative. So if we differentiate this function by lambda, it turns out the derivative is equal to the expectation of the return divided by lambda times the return plus 1. Now, if if lambda is 0, so this derivative is simply equal to the expected return. And in our game, the expected return was positive. What does this mean? Well, it means that at lambda equals to 0, the function, this function expected logarithmic return, will be increasing. But at lambda equals to 0, well, this function was 0. So if it increases, that it means that for very small values of lambda, the function will be positive. For when lambda is equal to 1, the expected return in this case turns out to be so the derivative turns out to be the expectation of 1 minus 1 over r plus 1. And in our case, we can compute this, and it turns out to be negative. So yeah, at lambda equals to 1, the function is decreasing, and it's negative. And so the conclusion here is that the reason why we can choose an optimal leverage which is not 0 or 1 but some number in between is because we have this very special situation where the expected return of our game is positive, but the expected logarithmic return is negative. Okay, so yeah, and that's it. Thank you for listening. Are there any questions?
So as far as I understand it, the standard statistical methods like Sharpe ratios are not very accurate when we talk about highly volatile assets. Is it possible to have a Sharpe ratio measurement that accounts for high volatility assets?
Um, I would uh, replace the normal returns with the logarithmic returns in the formula for the Sharpe ratio. And I would try to use this instead. I don't know what Alex or Jan think, so maybe they have better understanding. Well, let's see where this is.
Well, but if we talk about highly volatile assets and the returns are very high, then isn't it the case that logarithmic returns has this property where they uh, um, like from mathematical perspective it's not correct to do that, to use logarithmic returns?
I think that the whole the what we show here is that it's better to use logarithmic returns than normal returns. And when they compute the Sharpe ratio, they use the normal returns, as far as I can see in the literature. Maybe a better value, a better thing to use would be Sharpe ratio using logarithmic returns. So this means in this formula, everywhere you just replace r by logarithm of r plus 1. If we do this for our game, we will get indeed a negative Sharpe ratio, exactly like it is. And then there is something else. So here, if you try the leverage trick, it turns out that this lambda will cancel out. So the expectation of lambda times r is equal to lambda times expectation of r. So you get a factor of lambda in the numerator. Similarly, we'll get a factor of lambda in the denominator. So the lambda cancels out, which would mean that for any value of lambda, the Sharpe ratio will be the same. But if you replace the return in this formula by the logarithmic return, then things change. And I think we get much more reasonable numbers.
Okay, makes sense. So I guess in that case we should change the framework for the backtests to be doing exactly that, like looking at logarithmic returns instead of normal.
Maybe, but I was trying to find an example where we can see such problems in our pricing data. I haven't looked much, but so far I haven't found. So I looked at the Bitcoin data for the past several months, and the difference between looking at normal returns and logarithmic returns was basically negligible, because here this game is very special. So at every day you win or lose quite a lot, like plus 50% or minus 40%. So Bitcoin is volatile, but even with Bitcoin, you don't get such numbers day after day. The price doesn't change so much. But still, probably if I look more, I will probably find some places where we get much bigger difference. So if I find some coin where around a time where it is very volatile, like there is a lot of pumps and dumps, maybe I can find an example where using logarithmic returns will be more accurate.
Yeah, I definitely remember running into that issue at times where basically the Sharpe ratio I got when using daily returns was positive, but the actually overall returns of the strategy would be negative. So I guess that should not occur when using logarithmic returns, I believe, right?
Yeah, if the reason for this was what I explained here, then yeah.
Yeah. So I guess, yeah, I've seen that 1 or 2 times that you run into that, and that definitely shouldn't be that you have a positive Sharpe ratio while you're actually losing money. Like, I guess that should not be possible.
Actually,
Normally.
I disagree with this. I think Sharpe ratio can't work at all because in every economic theories, including this Sharpe ratio, there is a very strong assumption that the future is the same as the past. But in real life, it's really different. And with crypto, the trend is changing so quickly. So basically, Sharpe ratio is not really a good way to choose the strategy you want to
Well,
put in.
I mean, yeah, that's a valid argument, but in this game that I just showed, it is still true that the future is the same as the past.
In this game, that's true.
Yeah.
Oh, but if we are comparing strategies relative to one another, I guess using the same method should be fine. I mean, we just need to make sure that we use the same method for evaluation, and then such kind of problems should not be a problem.
I would say if it's a similar strategies, maybe, but if it's completely different strategies with different way of hedging risks, we might fall into a category when we can't detect any hidden risks, and again, this won't work. But for all standard strategies, I think it's better than nothing.
Yeah. It would be interesting to see more about those ideas. According to this person, he claims that basically economists have done some things wrong bec- because they've kind of used the wrong averages. And he has a lot of articles. So there is one. So besides this talk that I showed, there is one article in Nature, which I just saw today. So I haven't really read that one. And he has also one website that you can find where he talks about the different examples how people don't kind of have a wrong understanding of what's going on. Similar to what I explained here. So I don't know if this can have any practical consequences for us, but it's something interesting and it would be good to keep in mind.
I mean, it should be easy to just add the option in, for example, our backtesting module that you can ask it to get the Sharpe ratio either log or normal return wise. I think that's an easy feature to add. So we should at least have the option.
Honestly, after listening to this, for more radical adjustment, honestly. Now when I understand a little bit more, indeed Sharpe ratio makes no sense for me. No sense as a way of measuring. For crypto, are you able to identify the risk of huge dump coming? This is a key parameter. All this Sharpe ratio is useless unless you cannot answer to this basic but complicated questions. Can you, your environment, your framework, are you able to identify it? How frequently? So if you have a system which 100% of time identified every top coming, yeah, or warns you about the good system language. If your system have a good Sharpe ratio but miss one top, it's a garbage system because you lose 50% very fast. This is the reality of crypto market.
So, and this was my intuitive like feeling for a very long time. Like you maybe saw it from different ways how I try to push, like we need to evaluate signals and not strategies. Yeah. And now I'm getting more and more clear what is really key parameters which are relevant for crypto. Yeah, and the economy of crypto assets. They're super volatile, they're moving fast, and there is very little, I haven't seen any framework which can warn you some shitstorm is about to happen. Yeah, and we're in a good position. We do have metrics, we do predict it to some degree. So the key parameter for me would be, are we able, or framework, or we can call it strategy, or I call it signals, whatever, is it able to predict every single top? Yeah. And if it predicts more tops, is okay. But if miss one, it's not okay, because then your portfolio 50% cut.
I can very easily develop a strategy that predicts every top. I'm just going to say that the top is right now. Every time.
Yeah, it's a good question. Yeah. So, but then we need to.
So it's a balance, and also it depends on what time frame you talk about the top.
No, I mean, of course, there should be, when we build the parameters or measurement of such a framework or strategy, then of course, how many signals you generate is the next question. Yeah? So, not return or average return of your strategy, because if you build a strategy and it very much depends, does it take into account like all the tops, or you build it on the asset which experience only one top, will it catch the next one? Yeah, this key questions. But yeah, I don't think we can solve it like just in talk. Just getting more and more clear that whatever current economy theories are having mostly garbage for crypto, which we should dive deeper, or like deeper to specify for us a framework which is relevant. Yeah.
I would say that the story about hedging your risks, so it doesn't matter how much money you can gain. In that case, it's much more important how much money you are ready and you are not ready to lose. So if you become immune to all the situations when the strategy are misleading you, so you're basically immune to losing some money, you leave enough force for yourself to gain from the like these risky situations, and still you don't fall into catastrophe if you lose too much in the other case. So maybe there is no need to identify every top, but it's more important to
that's correct, Alex, because I like say what I said, it's very radical and extreme. Of course, the truth is somewhere more moderate and balanced, but I just wanted to push out the most extreme view. And yeah, of course, it doesn't need to tell you every single top before it happens, but early enough or after it has happened, and you should be aware, like this is what's going on, like around, not after you lost 50% of your portfolio, and the system says, oh, you know, that the trend has changed because a simple move in averages is what they're doing. Like crypto moved, yeah, 50% a cut. And then they say, okay, now the bear market, thank you very much. It's too late, especially if you entered into the long position the last half of the trend. Or actually, now I'm thinking it very much depends when do you enter the trend, yeah? Because if you're entering the trend, and even you're doing it repeatedly, and you fail with 5-10%, you're trying to catch the bottom, but finally you got it, then it's a one story. Yeah, if you got into a strategy which is working like this, it trying to catch the bottom, fails, then catch it. So your risk tolerance is much higher than someone who believes into, okay, I'm entering the trend after I got confirmation. So you will lose initial 20, 30, 50% of gains, but at least you don't lose on this constant attempt. Yeah, but then of course you should be much more risk averse and be on a protective position because you need to live also at, you don't have luxury to live too late when the market is crashing, because it can destroy your the whole strategy. Yeah, but anyway, thanks for this sharing. I understand a little bit more from mathematic point of view, and yeah.
I'm just thinking that. So from listening, like I missed the very beginning, but from listening this, I don't think we should fall into the narrative that what economists are doing is complete bullshit. Like it seems to me that yes, there are certain cases where the certain games and certain situations in which we get weird results, but that doesn't mean that generally the approach is wrong or it's going to lead to disaster if you analyze a certain strategy using it. And I think it's one strategy to try to chase tops and bottoms, but it's not the only strategy. You can also have a strategy where you find certain conditions which in most of the cases, let's say, lead to increase in price, and you exploit that. And if it happens frequent enough and you're able to detect it with high precision and you get good enough results, actually, if you put this strategy as part of your general strategy, it's going to push your returns higher than not using it. So you can have many different strategies out there. I think it's not only about catching the tops and the bottoms.
For sure. No, don't get me wrong. I give it as an example. How the risk has to be, or parameters for evaluating a strategy, how they should be done, in my opinion. And in many cases, yeah, it should be a set of parameters where you see, okay, it looks more likely to me according to what I see or what machine. It will lead to price increase. And it doesn't matter if it's bottom, top. Then there are a set of other parameters which define how you structure your strategy. Most likely it will be how much risk you're willing to take on it. I agree on it. On this, I don't disagree. But maybe I really, I wouldn't keep us too much attached to economic models. Just because they didn't really work in a normal life. They never will be able to predict no crises, nothing. But there are examples of working quant managers or developers or financial engineers, and they do use some of the stuff which is we know as a classic, but they use a lot of things which are not so trivial. Yeah, a little bit different way how they define the framework and what is valuable, what is not valuable.
Well,
so we should strive to this direction. Yeah.
There was this thread that you recently sent on this algo trading subreddit, where someone was asking, okay, like if pretty much the approach is clear, that in building strategies, analyzing returns and all that, why like regular people are not able to profit a lot or something like this, and only like hedge funds are doing it. And I think the answer there that one guy wrote is that it's actually a much bigger process. Like it comes down to execution of these trades, how you allocate your portfolio between the different strategies, all this kind of ceremony around plugging these strategies into something that works in production. It's actually the secret sauce. It's not so much about how you, for example, compute your Sharpe ratios or how you build the perfect portfolio or something like this, but it's around plugging this all together and making like a system that actually executes the trades, manages the risk and all that. And this is kind of the secret sauce that the hedge funds are going to have.
Correct. And you mentioned it. It's all about how you define and manage the risk. This is a key component to sauce when it becomes tasty. if this part is missing, the rest is garbage. You will lose money anyway. So, but if regardless how good strategy or signal is, if you know how to manage and execute the risk part of the game, wow, you are doing it well. And I believe we are like getting closer to sharing, understanding and sharing the framework, which is really important when you deal with crypto. This identification of risk, yeah, and be able to execute on it. Yeah, this is a key point. I agree with it.
Also, don't overestimate the funds, because according to statistics, over last 30 years, only 3% of venture capitalist funds beat the market. If we consider S&P 500 as like the market value, like 97% of funds, that was not so good, I would say.
Yeah, makes sense, because this is how it should work. Everyone cannot be profitable. Should be, well, 3% a bit loss. I would expect 5, 8,
This
but okay, 3%.
this corresponds very well to the first example in this game that I showed. So if you have 1 million players and each plays for 60 times, on average you win. But the average person would actually lose. And if you look at the distribution of how much each person win, it will turn out that a very small amount of people will win most of the money, but like 90% of the people will have lost after 60 turns. So that is very close to what Alex says. Okay, we have hedge funds playing for 30 years, and a very small amount of them have gained a lot, and most have lost.
Feels like we're getting closer. Not there yet, but we're getting closer.
Yeah, also going back to this intuition about this game. So if you compute the tree of returns, so in the first day, there is two possible situations, like 0.6 and 1.5. I mean, that's your money. And if you expand it to a few days, so on the first day, the mean value of your returns is positive. It's 1.21. So that means that it's profitable, but the real case is median value, which is 0.8. And that means that basically you're more likely to lose than to gain. So using these median values instead of means, it's also a good practice.
Yeah. I think also, like, this is really something that I think a lot of traders really don't see the core of this, which is basically, if my asset goes down 50% today and 50% up tomorrow, I'm not back to zero, basically. I'm down 25%. And that kind of accounts for this whole crypto Bitcoin versus altcoins, because if Bitcoin goes down 1% and goes up 1% tomorrow, it's more or less back to zero. While if an altcoin goes down 15, like 15%, and then goes up 16% the next day, you're still in the negative, actually, even though you would intuitively say, well, I must be up. And I think that's really something that a lot of traders are getting confused about.
And that's basically this phenomena of catastrophe. So one day you may fall into the situation where you don't have funds to bet again.
Yeah. Okay, so maybe we can finish for today. If I don't know, is there anything else important that anyone wants to say, or no? I think everything was said. Yeah.
Could you share all the materials? I'm interested in the link of that.
Okay, I will share it in the chat after that.
Okay. Okay, thank you, Tzanko, for the seminar. It was cool.
Thank you for listening.
Thank you.
Yeah, really cool. Thank you.
Thank you.
Thank you.
Bye.
Bye bye.
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 Bye.